Hello everyone, welcome to my channel. I hope you're all staying well during this time of virus. In Hong Kong, our daily new cases numbers are coming down, so hopefully in a week or two life can get back to sort of normal. But in the meantime, I hope everyone stays healthy and well. So today's video, I want to talk about really some simple reminders when it comes to investing. We've been doing some tidying up. I mean, I had no excuse having to stay at home for so long. There were a couple of boxes that have been gathering dust in a corner, and it really housed all the statements that neither my husband nor I wanted to deal with. So we kind of ignored it, put it in a corner somewhere. But at the back of my mind, I always knew it was there, right? Kind of glaring at me. So I decided recently to clear it out. And in there, I knew they had bank statements and other kind of account statements. But then I was really surprised to find some of the brokerage accounts that I'd forgotten I even had from years ago. So these are statements dating back to like 2000, 1999. So I'll show you, right? So for this account, this company, KGI, it doesn't even exist now anymore. So I found these statements from 2001 to 2003, and it looks like at the time I did a monthly saving plan with them. So each month they would deduct $5,000 from my bank account and to invest into the TraHK fund, which is like the Hang Seng ETF. So I did that for about less than a year, and every month it came out of my account. Now, thinking back to 2001 and 2002, we would have had 3 of our kids. So we have 4 children. So at 2001, we would have had 3 kids already. And so we had our hands full. And I think the reason I stopped, because I noticed that the monthly plan stopped in March of 2002. And thinking back, I think the reason I stopped it was because that year we actually bought our apartment, our home to live in Hong Kong. Because prior to that, we were always working under the assumption that we would only be in Hong Kong for a few years, and ultimately we would go back to the UK. So we always rented. But by that time, after 3 children, we kind of realized that we weren't going to leave Hong Kong anytime soon. I mean, the primary attraction is that at that time both of our careers were going pretty well. Plus we have the domestic helper, Osma, and her sister as well, Carol, at the time, helping us, looking after our kids. And there would have been no way I could have carried on working, both of us working, if we didn't have helpers. And I know from girlfriends in the UK how much of a struggle it is with kids and working, dropping them off at daycare centres. And it's even more a nightmare if one of them fall ill. So we had that luxury, and we recognized that. We were very lucky. So at that stage, we realized we weren't going to leave Hong Kong anytime soon. So we thought we might as well buy our own place rather than paying rent each month. And I think that's the reason I stopped the monthly saving plan, because really money was a little bit tight. But I also found another securities account, and this is a little bit embarrassing. This is how old it is, right? The paper is actually yellow and a little bit moldy. And in fact, this company, CSFB Direct, later merged with China BOCI, China Banking, I think, online trading services. So these are also from 1999 onward. In fact, I still have this BOCI account. But looking through the statements, right, and I'll show you a couple of investments that we still hold from those days, from like over 20 years, right? It has brought to mind 3 really good reminders that I think we can all do with thinking about. Because let's face it, right? Investment can be complicated, or it can be as complicated as you want to make it. So you go on YouTube, and there are loads of videos being made by different experts, right? And they'll tell you, they'll show you different models, or they'll promote different schemes. And it can get really, really confusing. And I'm an accountant, And I find it confusing. So I feel for those of you who say, right, you know, it's just too much to get a head around. But I do buy into the theory that you shouldn't invest in anything you don't understand. Like, you know, I remember during the financial crisis, there was a product that was being heavily promoted in Hong Kong as a kind of investment product, and it was called the accumulator. And I remember at that time I was talking to my sister-in-law, because she's one of those private bankers who was selling these products to her clients, and she was explaining what accumulator is all about. And I remember the more she was explaining it to me, the more I was getting confused, because I was saying to her, this is not an investment product, this is speculation. She said, no, this is, you know, this is a safe product yielding high interest and with minimal risk for her clients. And I said, no, not from the way you're explaining it to me. In fact, we got into a little bit of a disagreement over that. And lo and behold, a year later, it all fell through, right? And there were people demonstrating outside the banks because they've lost a lot of money buying into something like that. And even now, right, there are different insurance companies promoting different kind of products with very fancy names. And when you ask them to explain it, they kind of give you all kind of guarantee, non-guarantee return and other kind of clauses and caveats and assumptions. And it gets to a stage where I don't want to think about it. So looking through my old statements, there are three glaring points that I wanted to share with you all. So this is the a summary in Excel of my KGI monthly saving plan. So as you can see here, I started in May 2001, and in May, with my 5,000 Hong Kong dollars, I managed to buy 361 units tracker fund. And after that, you know, I had 5,000 invested each month. So 361 units in June, and that took me all the way up to December. And so at the end of the year, after 7 months of monthly investing, I had quickly accumulated 3,000, just over 3,000 units of the tracker fund, relatively pain-free. So, you know, that money is deducted from my bank account on a fixed day, and I really didn't miss it too much. Looking at 2002, that went on till March, so I stopped in March. And as I explained, I think it's because we were buying our flat, our apartment, and money was a bit tighter then, so I stopped. But even, you know, with that 2 months of investing, so I started the year with just over 3,000 units, and by the end of it, I had 3,000, nearly 4,000 units of tracker fund. So again, this is one, I want to demonstrate that it's relatively easy to build up the holdings steadily, monthly contributions, right? It's a little bit like our MPF pension contributions. So if you put a little bit away each month and let it do its things, investing, hopefully by the end of 20, 30, 40 years, you will have a nice little nest egg. And I want to show a couple of other sort of relatively safe investments which we still hold to this day. So this is Hong Kong Gas, and here I started at the start date 2003, but in fact when I look back, I bought Hong Kong Gas in year 2000, and at the time I had bought 4,000 units of it, and I spent just over nearly 38,000 Hong Kong dollars buying the 4,000 shares of Hong Kong Gas. And over that time, I never added to it, so it was the 4,000. But you can see though that the number of shares steadily increased, so that to this day, as of June of this year, it had grown to 15,000 shares of Hong Kong Gas. So Hong Kong Gas is a company that likes to issue scrip dividends. So you can choose, instead of receiving cash, to receive shares in their dividend payout. And I would tend to take shares. Although here you do see there were also cash dividends received as well, right? So as well as my shareholdings increasing from 4,000 to 15,000 over the last 20 years, I had actually received over 46,000. I would say 50,000 because remember, I don't have 2000, 2001, 2002 records here. I must have mislaid them somewhere. But I would say that I would have roughly about 50,000 Hong Kong dollars received in cash, which isn't bad, right? When you think about it, I only spent 38,000 buying that 4,000 shares in the first place. When I bought it, the average price was around $9.50. So when I checked the price yesterday, Hong Kong gas said 11.04. So it hasn't gone up much in 20 years, I must admit. But still, though, due to the fact that they pay out most of their profit, either in shares or in dividend, cash dividend, the value I've got my value back basically in quadruple. And still, the holding to this day is worth 4 times more than what I initially paid for it. Another company that's also very steady, utility companies, is Hong Kong Electric. And again, back in 2000, I had bought 500 shares of this company, and I never increased from that 500. So right up until May of 2020, you can see here, I still have 500 shares. And at the time when I bought it, it was at $23 per share. So the money I spent purchasing it was 12,000 Hong Kong dollars. But here it's a little bit different to Hong Kong Gas, right? The price of the shares as of yesterday had more or less doubled to $44. So my value of this 500 has more or less doubled, right? But not only that, during that time, Hong Kong Electric has been paying dividend on a regular basis, twice a year, interim and final. So that at the end of it, I actually received 28,670. So remember, I haven't included the year 2000 dividend here. So it's probably looking at like 29,000 in cash I received over this time. Where I only spent 12,000 on it. So again, that to me, it's generated a nice little profit. So TraHK is the one that I favor the most. And I know there are people, investors out there who turns their nose up at TraHK fund, saying how boring it is. It's not glamorous. It's got all the old, steady, large companies. But for someone like me who don't want to actively manage my holdings, this is a very easy way to make sure my money stay invested in the market, in the Hang Seng index. So as you can see here, I have 16,000 shares. So I think I also subscribed to the initial IPO, which is why I have so many shares here. But I haven't really bought much more throughout the year. So the increase you see here is again from the scrip dividend that the company issued. So instead of getting cash, I will often elect to take shares instead. So from that humble 16,000 beginning to now, I have 21,000 shares in the TraHK fund. But the dividend, I also received dividend all through these last 20 years. And the dividend alone comes to 232,000, nearly 33,000, right? Which, when I bought it was roughly at the price of $16. I would have spent 256,000 buying it, the initial investment. But now it's grown. As of the price of yesterday was I think around 26 per share. So given that I've received, my holdings has increased due to the scrip dividends, my holdings now is worth 567,000. So I have more or less doubled from my initial investment. Plus, I've also received 232,000 in cash during this time. So these are 3 examples of where you invest in quality companies, quality equities, and you just let it sit. Don't play around with it. Don't fuss with it, and it will steadily grow. It's not going to miraculously make you a millionaire, but if you give it time, it will accumulate. And I want to show you here is a chart of the Hang Seng index and the TraHK fund since inception. So since it started in late 1999. So as you can see here, there's been a lot of ups and downs. So it reflects all the crises we've experienced, right? In 2002, we had SARS in Hong Kong. Here, the big dip is due to the global financial crisis, where the Lehman Brothers collapsed. Another big dip here was in 2016 when the Chinese market, the China share market, was very volatile. And more recently, earlier this year, when the pandemic started in February, also the market took a dive as well. But the one thing to note here is that if you look at the overall direction of the chart, is that it's gone up, right? It started, so forget about the very bottom and the very top. Just draw a straight line in the middle. It's sloping upward. So which means, right, the market has increased in value over time. So the key here is over time. So you got to give it time to build your wealth. You're building your wealth. You're not gambling it. You're not speculating. You're building. Okay. Thank you. So I hope, having looked through a sample of the shares that we still hold, right? Hong Kong Gas, Hong Kong Electric, the TraHK fund. I hope you can see that building wealth doesn't have to be complicated. So that's my first point, right? It can be complicated if you want to make it complicated, but it doesn't have to be, right? And the second point is that, so long as you save, you just take that first step each month, put some money away. And you can start off small. It doesn't have to be a large sum of money. Everyone's situation is different. Everyone's in a different earning bracket, right? And in the different stage of their lives. So as you saw, I started a saving plan, monthly deduction, but I had to stop because, we were buying our first home. But then I know for a fact, as soon as I was able, I started investing again. It wasn't quite in the same thing. I think I bought into Fidelity US mutual fund, and I went on with that each month, saving I think 6,000 Hong Kong dollars every month for a good 10 years. And because I was doing it each month, it became a habit. I didn't really miss that money, right? That was a good thing about it. Because let's face it, right? If I had that money sitting in my account, there was every chance I would have spent it with nothing to show for it. We could have taken a holiday, or I could have, spent it at our home, buying furniture or something like that. Instead, right, by saving it each month, I was slowly building up my wealth. So I would say to all of you, right, if you're able, really just put some money away on a regular basis, steady, regular saving. That's the way to your goal, right? You're not competing with anyone. You're not comparing yourself to anyone. Really, right, what you want to end up with, the object of the game, if you like, is that you want to have this much money, and then 20 years later, hopefully your money would have gone to a much bigger pot. So that's the goal, right? So steady and regular, right? The third point is, right, is that we need to take a long-term view on the saving, right? No one can predict the market. In fact, you Google it, right? I think over 50% of the active fund managers, and these are the experts, right? These are the guys who are investing your money as a profession. They get paid for doing it. Over 50% of them do not beat their index. So they do not outperform their benchmark. So no one has crystal ball. But hopefully by seeing I showed you the Hong Kong Hang Seng index, and it showed, the up and down on the graph, right? But the main thing you got to get from that is that the overall curve is upward. So if you take a long-term view over 20 years, it would have gone up, right? It was going up, going in one direction, that was up. So if you left your money in there and you didn't get scared in between and sell out, you would definitely have made money in the last 20 years, as I did, right? Looking at my holdings of TraHK fund. I personally favor buying ETFs. These are exchange traded funds. So these are, pre-packaged basket of equities in different companies. Because I'm not good cutting my losses. So I'm one of those people who's still holding quite a lot of Hong Kong Hang Seng, Hong Kong Bank, HSBC. Because in the early days, right, that was the stock everyone held for long term. supposed to continue to have capital growth, decent growth. It paid good dividends, so this was the vehicle many of us invest in for retirement. And then when it started dipping, emotionally I couldn't let go. So I'm not a good investor of my own portfolio, but buying into a fund means that decision is taken out of my hands, right? Because naturally the fund holdings of companies will readjust, rebalance depending on the index that is benchmarking against. And plus, because it's a ETF index fund, the management fee is low because there's really they're not being paid to actively manage it, right? They're just mirroring the index. So the management fee is relatively low as well. So I favor that. And in fact, Warren Buffett, one of the most famous investors of all time, when he divorced from his wife, so obviously his wife got a whole chunk of money, he actually advised his wife to put the bulk of her money, the divorce proceedings or whatever, right, into an index fund. So really just go with the market, because he knows that she wasn't going to actively manage that large chunk of money. So that was his advice to his wife. So if it's good enough for Warren Buffett's wife, it's good enough for me, I think. Now I know, right, many of you watching this are probably seasoned investors yourself, right? So I'll be really interested to hear if you can share how you are going about building your wealth, because I'm sure there's more than one way. Let's face it, there's more than one way of building your wealth, right? You can invest in companies, you can invest in your own business, you can invest in properties, fixed income, etc., right? But one thing I know for a fact that we shouldn't be, or I would urge all of you not to be using as a way of building your wealth, is to leave your money in the bank, because interest rate is like zero, and it hasn't been high for the last decade, over that really. So please do not take the easy option of leaving your money in a fixed deposit or leaving it in your bank, because you are losing money, because inflation is definitely higher than the interest rate you're getting in the bank. Okay, so I'll leave it at that. So if you find this useful, please, for a small channel like mine, I'll really love it if you would subscribe and share and like, because YouTube algorithm really look at what you guys are telling it. So that will really help my channel to grow. Thank you. Bye-bye.